Hey everyone, so today I have the task of creating a portfolio for my grandmother. She's 84 years old and she knows nothing about investing. All she's ever done in her life is save up some money and keep it in the bank. She has no idea what shares are, she doesn't know how money really works. I have to be really conservative and not try to freak her out with anything too too risky or anything that she thinks is a little bit risky, even if I don't think it is risky. So I have to keep it really low volatility as well because she's old. She doesn't want to be able to handle the big drawdowns of like a 50% pullback in the market and that bring her net wealth down 50%. She won't be able to handle that. So I have to be ultra conservative. So here's my attempt at that. Oh, and the caveat here is that my grandmother actually distrusts pretty much everyone and everything. So she doesn't have trust in governments, doesn't have trust in banks, even though that's where she's put her money in the past. She really has trust in nothing, so I have to be pretty diversified to give her some sort of security. So the first step is to put 25% of my grandma's net wealth into 5 different government bonds, and in both 2-year and 10-year timeframes. So that's going to be 2.5% in a 2-year and a 2.5% in a 10-year government bond in these countries: the US, Sweden, England, Australia, and New Zealand. So why those countries? Well, I don't know about your grandparents, but my grandma is a bit of a racist, a bit of a bigot. It's actually really hilarious. I had a very interesting conversation about this with her and I laughed nearly the whole time. So she doesn't like a lot of the world. She doesn't trust Asian countries. I think I can repeat what she said about China. She said, those Chinese are hard workers, but you can't trust those commies. Something like that. Which made me laugh. And then regarding South America, that was definitely off the cards because when her and my pop, they traveled to Brazil like 30 years ago, my grandfather, my pop, he was pickpocketed there. So that now entire continent can't be trusted, and that's completely uninvestable according to my grandma. And then there are a range more reasons why she didn't want to invest in other countries. I can't repeat most of what she said, especially about Africa and the Middle East, but it was hilarious and it was all pretty wrong. So following that strategy of 2.5% in 2-year and 10-year bonds in those 5 countries, at the moment, that would all get locked in and the return would be around 3.37%. On average across those 5 countries. Now, the trick to this one is that I have to get electronic copies and physical copies and store them myself somehow safely. So I need to store them in multiple locations that I can access and 2 other trusted people can access as well. There's a fair bit of work here just in setting this up because I didn't want a broker or a third party holding those bonds, because I think this is supposed to be the most conservative part of the portfolio, and I didn't want a third-party risk of a business that I'm entrusting to hold those bond certificates. They go out of business, or a fire burns down their building, or I don't know. I needed to have I needed to take that responsibility myself. So yeah, that's how I sort of had to approach it. So I had to go shopping to buy some safes, which is actually surprisingly fun to do. It was kind of felt like I was some doomsday prepper, but anyway, it was interesting. Now, why government bonds? Well, I believe that governments actually have a lot to lose if they default on their debt or they default on their bonds, which is the debt. And I would argue it is more likely that a bank or a company will lose your money than one of these governments. But if any particular country does have a catastrophe, well, that's why there is more diversification here as well. That's why I've got it split between those 5 countries. 3.37% doesn't keep up with inflation at the moment, but it is superior than keeping it in a low interest account in the bank. And the point is, I'm saying that it's actually safer than having the cash in the bank and you still get 3.37%. Next, I'm going to get 15% of the portfolio and split it into 5% lots and invest it in 3 rounds of AAA graded corporate bonds. This is my suggestion. Why a corporate bond? Well, when a company goes bankrupt, they liquidate their assets and pay people according to the investor their debt stack. It's like an order. So at the bottom of this are the common shareholders, and above this are the corporate bonds. So when the liquidation happens, money gets paid out to these people first, the bondholders before the shareholders. Therefore, it is inherently safer than the common shares. Now, I think the big issue here with corporate bonds is that you kind of have to be rich to get access to this market. It's kind of bull. But anyway, lucky my grandma has a lot of money, so I would consider her rich and she can access this corporate bond market. But for most people, it's pretty inaccessible. Now, I wanted to get her Apple and Microsoft corporate bonds because I think they have amazing balance sheets and I think they're super stable. I think there's a very, very high likelihood that you're going to see all the coupon payments and your money at the end. But my grandmother doesn't really like tech companies. She doesn't understand them. So I had to be a bit more risky in my eyes, but it was less risky in her eyes. Now, if you are interested in the corporate bond world, you really need to shop around for different brokers. It's very old school. The fees are really high. It's all quite archaic, honestly. It's pretty bullshit industry, I believe. It's ripe for technology disruption. If people wanted to access the corporate bond world, they really can't without going through these middlemen and who rip your eyes out with fees. But anyway, I'd shop around and I would make sure they try to get the best fees possible for her. So anyway, my grandma wanted some nice, safe Australian companies that she was familiar with. So I'd go with National Australia Bank, Westpac, and Woolworths, for those familiar with those companies. Essentially, they're two banks that she knows really well and the grocery chain that she shops at. And those three companies have pretty strong balance sheets and have long track records. So I feel pretty safe about these anyway. Now, another interesting thing is there's actually legal requirements that are changing in Australian law with the banks in particular. So up to now, banks have had to have about 3% of their debt, I think it could be 3% of their liabilities, issuing corporate bonds. They have to have 3%. But now it's going to move to 6%, which means that's going to have to double the amount of bonds that all the banks have on issue, which means they're going to issue a lot to the market, which makes it good for the consumer who's who wants to get corporate bonds. There's going to be a lot of competition fighting for your money. Therefore, interest rates on these bonds are going to be really good. I think you can get 8% in the next 12 months. I think that's very likely. So it's pretty cool. If I can lock my grandma in for about 5 years with some of these banks at around 8%, I think, well, after fees, let's say 7%, that's a pretty good deal. So next up is I'm going to put 10% of the funds and I'm going to split it into 2 short-term term deposits, about 1 year in length. Now, term deposits with the bank aren't as good as the corporate bond returns, but it's also significantly better than just having cash in the bank. Now, I definitely would choose 2 different banks from the ones that I would use with the corporate bonds, just to add that extra diversification just in case something crazy happens. And the return on a term deposit at the moment for a 12-month period is about 4%. Now you might be thinking, why term deposits? Why bother? Why just get more corporate bonds? Well, see, my grandma is just very familiar with term deposits as she's been just doing this all her life already. So she feels good about them. I don't particularly like them, but she likes them, so great. I have to make her happy. It's her money. Okay, term deposits are a little bit higher up the order in terms of the debt repayment schedule with the bank, but like the corporate bonds are very safe and you're going to get close to 8% compared to 4%. I think that difference is worth the extra risk, which I think there's pretty much no risk anyway. Okay, so the next 10% that I would use of my grandma's portfolio is I'd put it into real estate investment trusts or REITs. And I'm looking for REITs that have great diversification, low fees, and are well managed. So I'm looking for a lot of different exposure here. So we're talking about trying to get, say, agriculture, commercial, residential, industrial, and even niche real estate exposure, and throughout many countries of the world as well. So my plan here would be to get some REITs from different countries, maybe Ireland, maybe Australia, the US, and find good diversified low fee REITs. Some examples of some good REITs are IRES, which is in Ireland and it's a large residential REIT. Then you've got Brookfield Asset Management in the US and they have a lot of real estate under management. So maybe that could be considered a REIT as well. Public Storage REIT in the US might also be a good niche option, a good niche exposure option. You're investing in all those storage yards and storage centers throughout the States. So this is the real estate play of the portfolio, and I think a REIT is actually far better than trying to manage properties on my own. I wouldn't get the diversification, and I don't have the time to do it all. a good REIT is a great solution for that real estate puzzle, I think, of a portfolio. Because like if I buy 1 or 2 houses, let's say I buy even 3 or 4 different apartments, where are they going to be? I have the inherent risk of them being on one street in one city in one country with, if I'm only got 3 or 4 places. But a REIT, I can get hundreds, even thousands of different real estate options in all different fields all over the world, and still be able to have the ability to liquidate them if need be, or I don't have to manage them, essentially. That's the best part. In the video where I go through the safest investments of the world, I go through all the pros and cons of all of these things like REITs and bonds and stocks and all that stuff. So go back and watch that video if you want more explanation into why I think some of these investments are good and bad. Now, the best way to hold a REIT is actually just through a few different brokerage accounts. So Interactive Brokers being my first pick. And if you follow my channel, you know why, but Interactive Brokers is the safest broker I have found. It gives good access throughout the world. It has a good track record over many decades. And look, I'm not going to get into Robinhood for my grandma. Or any of those different types of startup-y kind of apps that are trying to be brokerage accounts, but they don't have the track record. I really need to be safe here for my grandma. So Interactive Brokers in particular. Saxo Bank is another reasonable one. I'd go Interactive Brokers first. Link in the description if you want to give Interactive Brokers a look for yourself. If you don't have a second brokerage or a third brokerage account, I really think Interactive Brokers is what you should be having. So the next allocation is I would put 20% of her money into low-fee global index funds with multiple custodians. What I mean is, like, I'd use Vanguard and BlackRock. I think there's a Vanguard World ETF and a BlackRock World ETF. I would split it between the 2 of those, so 10% in each. I would also hold those in 2 different brokerage accounts. So let's say I had Interactive Brokers and Saxo Bank, I would split it between the 2 of them as well. So why these particular ETFs? Well, we get global exposure through these ETFs with, I think, low risk, low fee exposure to the best companies in the world. And as the world improves, so does this ETF. I chose global over the S&P 500 because I think having mostly US exposure isn't as good as having global exposure. I don't really know what the future holds for the US. Maybe they default on their crazy amount of debt, or they get silly and print too much money. I don't know. Better to not be completely exposed to the S&P 500, I guess. The global ETF actually has plenty of US exposure in it anyway. It's actually 62% of the global ETF is US companies, so it's still heavily in the US. But if the world dynamic was to change and US companies started to drop down, they will be replaced by the biggest and best companies in other parts of the world. So if I was to actually look at the top 10 holdings in Vanguard's Total World ETF right now, the ticker is VT. There's 9 US companies here. So Apple, Microsoft, Amazon, Google, you know those names. And the only one that's not a US company is Taiwan Semiconductor. And finally, the last 20% of my grandma's portfolio I can have a little bit of fun with. So this 20% I'm going to put into what I would consider the best and highest grade individual companies that I know of. So they need to have impeccable management. So I've gone with Berkshire Hathaway, Markel, Technion, KPG. I'll think of some similar companies that I know really well too. And I'm going to split these between multiple investment brokers as well. Interactive Brokers, Saxo Bank, for example, Fidelity, if I can get it, and maybe another one if I can find it. I believe these investments can do more than 10% per year across a long period of time. My grandma is okay trusting me with this amount of money to invest in the companies because she feels really good about the rest of the portfolio, the other 80%, and how safe and diversified that is. So if something crazy happened in the stock market and the markets fell 50%, even these amazing companies, well, it would because I've got 20% of the net wealth in that would be like a 10% reduction in the overall value. That is something that my grandma can handle, but she wouldn't be able to handle a 50% drawdown in the entire portfolio. So that's why I've done this approach. Now, I did tell my grandmother this is not how I would invest my own money. Of course not. But at 84 years old, maybe this is what I would also do. There is a big part of investing that I'm calling the sleep factor. See, if your portfolio is making you nervous, it's worrying you, you're potentially thinking about it at night, well, I just don't think it's safe enough. And the most important thing for my grandma is at her age is reducing stress and anxiety levels. So this is like an anti-stress, anti-anxiety portfolio that she's really happy with. Now here on the screen, I've showed you the breakdown of the portfolio with the estimated returns for each of those segments as well. So it's around about a weighted 5.8% per annum estimated return across the whole portfolio, 5.8%. But let's factor in some unknown unknowns into this. I don't know, Armageddon, nuclear war, something crazy. So I could expect around about 5% per annum from this portfolio. So this is better than all of it in index funds or all of it in the bank because it has large amounts of diversification and fail safes. Even if something insane happens like the US defaulting on their debt, maybe that sparks a 80% collapse in the markets. I don't know. But with the REIT income and the term deposits and the corporate bond income, that'll all still be working. So I would say this is probably one step above like doomsday prepping. If we were to have a real insane event happen, like a nuclear war, for example, well, I don't have an answer for that. Now, hopefully my grandmother can sleep easy with this and she'll get a reasonable return for the rest of her life and she can feel really comfortable with that. How would you structure a wealth portfolio for your grandmother? I'd appreciate any of the comments. Maybe I can optimize something here and I will see you next week.